Okay, welcome guests and panelists to our first time buyers seminar. I am Robb Fleischer, broker of AMSI and our real estate brand Novo. Our objective today is to guide you through the first steps of building a roadmap, help you make informed decisions, and empower your advancement towards home ownership. The process is most efficient and effective with the expertise of different professionals with very different skills, knowledge, and focus, while mitigating what can otherwise be confusing and overwhelming for the first-time home buyer. Those professionals include realtors, lenders, inspectors, and escrow and title. I am very pleased to introduce today's panel of experts: Ed Diaz with Kuno Advisors, Alexia Cloutier with Cloutier Accountancy, Gary McDonald with Chicago Title, and members of the AMSI Novo team, Eli Meyskens, Gina Ocampo, Selma Bushell, Sylvia Sotomayor, and Jackson Salamunovich Hesper. Each of these professionals are passionate about what they do, and nothing pleases this group more than to help you achieve the American dream of home ownership and help you build wealth and to make the process stress-free. Please feel free to ask questions in the Q&A feature on the Zoom link and post questions that we'll attempt to address towards the end of the meeting as time allows. We've also will be adding a link to the chat, which will have some documents and references that some of the panelists have provided for your reading. At the end of this webinar, we will also show contact information for the panelists, all welcoming of your future questions. Sylvia, let's start the process with you and discuss where we start with the home buyers process.
Thank you, Rob. Today, I will be speaking a bit about what the home buying process looks like and the steps that process entails. The first and most important step in this whole process is aligning yourself and hiring the right agent. We'll speak about that more. Number two would be secure pre-approved financing. My colleague Ed Diaz will elaborate more on that a little bit later, but this is establishing your budget and how much home you can actually afford. The third step would be to find your home. This is really the fun part. This is the part of the process where you get to go shopping. You get to go to open houses. You get to interact with your agent and work together to actually physically walk through homes together. The fourth step would be to put an offer in and negotiate based on your budget. My colleague Selma will explain more about this in a later part, but based on your budget and guidance from your agent, you'll be able to put in an acceptable offer, a very competitive offer, and hopefully negotiate on terms for your home. The fifth process would be to work through contingencies and the inspections. Your agent will guide you through this process, and there are typically timelines during this very important process for contingencies and inspection reports that you will need to review, and your agent will help guide you through all of these reports. Last but not least is close escrow and become a homeowner. Congratulations, this is where title is recorded and you get your keys for your new home. I mentioned in the beginning of this process that the very first step and the most important step is hiring an agent. When you align yourself and who you align yourself is really critical for one of the greatest investments you will ever make. The agent-buyer relationship is crucial to help make the entire process less stressful. A good agent will want to speak with you and get to know you and get to know what your wants are, what your needs are. We really try to make this not an interview, but as a consultative process to really understand what your budget is, what size property you're looking for, what location is really important to you. Do you need to be by schools? Do you plan on having a family in the future? What are your future plans? We want to know all your must-have criteria and maybe things that you could maybe be flexible on. We are really, really trying to be a guide and more of a guide and advisor throughout this whole process. Your agent is also here to put competitive offers on properties. Again, my colleague Selma will go through this more in depth, but we are the experts. We see what the market trends are doing every day. We want to put an offer in that's really going to align you in the best possible light so that you can actually secure your home. I mentioned there's also contingencies and reports that we as agents see every day. We know how to pick out red flags. We know what we're looking for in title. We can help you possibly negotiate that rate based on what some obstacles might be with that property, or we can advise you to maybe pass on that property. That property might not be right for you. So we're here to really be an advisor and be your friend. This is an emotional purchase. Buying your first home is a very emotional purchase, and we're really here to make you successful in that purchase.
Rob, you're muted, just a heads up.
Okay, sorry, everybody, I got muted there. Sylvia, thank you, that was insightful. Ed, thank you for talking about the pre-approval process and some common questions that you receive from first-time buyers.
Yeah, so what I'm going to do is, and thank you everybody for attending. I hope you're really, really excited, because despite what all the news media is saying, believe it or not, 2023 is going to be the best year to buy. And I'm going to talk a little bit about that just for a second. Right now, what I want to cover is I'm going to cover the difference between getting pre-approved and pre-qualified. A lot of times consumers get those things very confused. They are not created equal. So let's go through pre-qualification. Pre-qualification is when you talk to a mortgage person and you give them an estimate, for example, of your income, of what kind of debt do you have, what you think your credit scores are. And by the way, depending on where you pull the credit report online, there could be a 30 to 40 point swing on that credit score. Keep that in mind. That's why mortgage reports are so vital, because they are the most in-depth. The next thing is they're going to ask you about how much money do you have to put down. Well, also the sourcing of that money is really, really important. And I'm going to talk about that in the second part, which is the 4 quadrants of getting pre-approved. So the pre-qualification is just an estimate. You tell the loan officer approximately all this data, right? Your estimates, and they will kick out and say, well, based on what you've told me, I think you qualify for $1.3 million, putting 20% down at an estimated rate of X, right? Depending on where the rates are at, which keep in mind that rates are not linear. They change every single day and sometimes throughout the day, depending on where the bond markets are at, because that's what they're dependent on. And also another thing too is interest rates are not a singular topic, meaning there's no rate. There's between 10 and 23 on average different rates on the rate sheet every single day. So there are some rates that cost you nothing, and then there are rates that you have to pay a premium for. Obviously, the lower the rate, the greater the chance you're going to pay a premium, and that premium is called points. To keep it simple, 1 point is equal to 1% of the loan amount, not the purchase price, but the loan amount. So the pre-qualification is just an estimate. It is not legally binding. Here's where the difference comes in. Now we get into the pre-approval. The pre-approval is when you literally provide all of your details, right? What are those things that we're going to provide? We're going to provide bank statements, the last 2 months, the last 2 years of tax returns, W-2s. You're also going to provide an authorization to pull your credit. We're going to actually pull your credit. And in that credit report, we're going to see credit scores. We're also going to see your debt. I'll talk about the specifics about each one in a second. Then we put all that information together, and then we submit it to the actual underwriter. Who is the underwriter? The underwriter is really a risk management person for that bank. They are looking, of course, to see about doing your loan, but they also want to make sure that that loan is not risky, because most loans are sold. So when they sell that loan, they want to make sure that that loan doesn't have to be bought back because they find out that maybe the numbers were not correct. Right? So they have to do a lot of due diligence. Now, when an underwriter approves your loan, that is now a commitment to lend. That is a real pre-approval. Why is that so important? Because it gives you leverage going in to put in an offer. When you have a commitment to lend, obviously you can give better terms, right? You can go in with no loan contingency, for example, right? And that puts you in a position that is stronger than a person who has a pre-qualification and doesn't have that commitment to lend, because they still have to go through underwriting. Now, what did I just describe? They still have to go through underwriting. Doesn't that sound like stretching out the process too? The other thing is that you're going to get better terms on when you can close. Because if you don't have to go through extensive underwriting, then you can close instead of 30 days, you can do 14 or 21 days, depending on your situation, how clean your file is. So pre-qualification, think about that, it's just an estimate. It really doesn't mean much, but at least gives you some kind of ease, right? That you can get a ballpark. The pre-approval is a commitment to lend. Those numbers are solid. You can go with your chin up high with Sylvia or Gina or Selma and or Eli and be ready to put in those offers. So that way, you know that you have a higher chance of getting your offer accepted. Now, the second piece is, well, okay, so how do the banks actually look at me? I'm going to pull up here a quick little form that I've created a few years back, and I call it the acid test, just because the brain does a better job at remembering these things. So think of it as an ACID, acid, right? A stands for assets. Well, how much money do you have for closing costs and also down payment, right? Programs start out with no money down. So for example, you can, if you're a veteran, you can go in with no money down, even with a loan over $1 million. Most people don't know that. And you know what? If you're a veteran, you should be able to go in with no money down, thanks to your service, right? That also loan has no mortgage insurance, for example. Whereas most loans, if you don't put 20% down, you're either going to have to do 2 loans or you're going to have to pay what's called PMI, which is private mortgage insurance. And you want to avoid that because it's kind of like having a car payment, but no car in the garage. You don't want to do that. You want to avoid that. If you're getting a jumbo loan, which, by the way, Fannie Mae and Freddie Mac just increased the county loan limits. If you are in a high-priced county, then your loan for one unit can go up to $1,089,300. So we've crossed that threshold of $1 million, which means that you don't have to get a jumbo loan because jumbo loans are a lot more restrictive on debt to income. You also have to have, besides down payment and closing costs, you have to have reserves. That's money that you cannot put as a down payment to increase, for example, your purchasing power, right? So you want to, in general, you want to stay to a conventional loan if you can. But there's all kinds of programs out there. There's literally hundreds of them, right? So assets. One thing I did want to also say about assets is that you cannot have cash, literal cash, somewhere in your house in the safe deposit box or somewhere, and then put it in your bank and then use that for this transaction. You cannot do that. All cash has to be seasoned in an account at least 2 months to be able to use it. Otherwise, it will be disallowed. Very, very important because I see that happening a lot. The next quadrant is going to be the C, which stands for credit. We all know there's 3 credit reporting agencies, therefore you have 3 credit scores. So in the mortgage business, we use the middle or the median score. We eliminate the high and the low. That's for risk management. So you're probably asking, well, what if I'm going in with other people? What score do I use? Whoever has the lowest of the median scores. So pick wisely who you have as a co-borrower. Don't get somebody who has a 580 credit score and you have an 800, because the higher the better. So what's that threshold of credit score that you really want to have? You really want to be at a 740 and above middle score, because that's where you're really going to participate in the best rates. That doesn't mean that you cannot get a loan. Yes, you can. You can get a loan with 620. In some cases, you can even get it with a 580. However, that rate is not going to be as great as if you have a 740 and above. The next is the I, which stands for income. If you are a W-2 person working at a company, we're going to use your gross monthly income. So we take the interval at which you get paid. Some people get paid weekly, right? So then we're going to times that, times 52 divided by 12, right? If you get paid once a month, then we use the once a month. If you get paid twice a month, we multiply it times 2. Or if you get paid bi-weekly, which is most people, we're going to multiply your gross by 26 because there's 26 bi-weekly payments in a year, divided by 12, and that's going to be the number that we utilize. Now, a lot of people get bonuses and or overtime or commissions. That's considered to be variable pay. There's 2 things you got to keep in mind with that. Number 1, it must have been paid out to you the last 2 tax years, because we're going to do number 2, which is average it over 24 months in order to be able to use it. So let's say you got it last year, a bonus, but you didn't get it the year before, you cannot use it, unfortunately. The next is the D, which stands for debts. When we pull your credit report, we're going to see your credit scores, of course, but we're also going to see your debt. Most people think, for example, if they have a credit card balance, that it's the payment that they pay that we use to calculate your debt. That is not the case. We use the minimum payment that's showing up on the credit report. But let's say you have student loans, and when we pull your credit, there's no payment because it's deferred. We will use 1% of the balance as your monthly payment, just so you know, even if it's deferred, because we know it's a real existing debt. So from the debts and the income, what we do is we divide the debts, including your new hypothetical monthly payment of your new home, divided by your income, and we come up with a debt to income ratio. Keep in mind that for conventional loans, you can go up to 50%. If you're talking about government loans, you can go above the 50% threshold. If you're talking about a jumbo loan, which is greater than, like I said, in the higher priced areas, $1,089,300, then your debt to income ratio that they allow you, the maximum is going to be typically 43%. So you take about a 7% haircut. All these things, notice a lot of moving parts are taken into account. Do you see why it's important to get a pre-approval and not just a pre-qualification? Because there's a lot of moving parts when we're talking about that. And we'll distribute, by the way, if you're interested in this form, please let us know and we'll go ahead and send you a copy of that. I also have some other really great informational sheets as well. And we all do it as well if you want to get a hold of those things. The next thing I wanted to talk about is, let's talk about rates, right? So everybody has been talking about rates. 2022 was the fastest period of which rates went up. So we went from a 3.22 on average to a 7.5. And it seemed like it was a bullet race car, right? When it happened so fast that it caught a lot of us off guard, including me, who've been in this business 22 years. I've never seen rates change that quickly. However, let's catch our breath. The reality is that if you look at the last 30 to 40 years, the average interest rate on a 30-year mortgage has been between 6 and 7. So we're kind of in a normal market. Now, I know we got used to free money. Who doesn't like free lunch, right? We all do. I get it. However, what really happened? Why is it that we had those kind of rates that we saw? Well, it was really the Fed. Part of the government, right? The Federal Reserve decided that in order to stimulate the economy, they created what's called the QE, which is the quantitative easing. You guys remember that term? Nobody talks about that anymore, but remember that term? Well, part of that quantitative easing was the artificially lowering of interest rates. So what happened? Well, of course, it created the greatest bull run in real estate history. Who's not going to get in and try to buy a house when your rate's in the high 2s or the low 3s? Everybody jumped in. So guess what? Do you think that with 30 to 50 offers on every property and properties going way over, do you think that sellers were going to give any kind of concessions or even remotely listen to you about lowering the price? Absolutely not. That is your biggest hint as to why 2023 is a great year to buy, because now in the first time in the last 10 to 12 years, you can actually negotiate a lower price with the sellers and maybe even get a seller concession that you can use to buy down your interest rate, because that's allowed too. That's a topic of a different, more in-depth webinar. However, these are all strategies that you can utilize now that you could not use before because nobody was listening, because everybody was basically, it was putting a bunch of sharks in a pool. They were all eating each other alive, all right? Now you can go back and be able to negotiate those things. Now, I believe my forecast is, because if you were paying attention, you know that today, Thursday in the morning, I said this yesterday, but this morning, CPI came in exactly where I said it was going to come in at 6.5%. We came in from 7.1 and it dropped to 6.5. Why is that important? You're thinking to yourself, that's only a 0.6 difference. It's because everything is emotion. And we already knew that inflation was coming down. Keep in mind that when you hear this data, it's usually 30 days old, right? So they're looking at December, but that's continued. And the reality is that inflation has been coming down. And so we will continue to see that. We are most likely, maybe, right? We think we're going to go into recession. Recessions are really great for interest rates, by the way. They always drop interest rates. So my forecast is we'll be in the 5s, in the low 5s by June, July, maybe even in the 4s by Q1 of next year, 2024. Now, here's the last thing I'm going to say. If you wait for the rates to come down to 5.25 or the high 4s, guess what's going to happen? You're not the only one who's going to jump in. everybody's going to jump in. You will have missed that cycle because now we're going to have overbidding again. We're going to have prices going up again because it's simple Keynesian, right? Supply and demand. There's going to be more demand, and that's going to drive up prices. And there's a psychological barrier. And I know that the fives is that cross that barrier. When we get to the fives, everybody's going to jump in, and you will be competing with another 20 to 30 people. And you will have missed the opportunity, one of the greatest ever. Just release fear, embrace your team, and let the professionals guide you, because that's why we're here. Us who've been here for more than 10 years, I could tell you right now, we're in this because this is a calling. It's not a job. We want to help you get in. We want you to achieve that dream of homeownership and take your family, your lifestyle, and your quality of life and your finances to the next level. I appreciate allowing me to talk.
Thank you, Ed. And I'm going to take this moment to again remind all of our guests, there are so many details in this process. The group of us could talk hours about all of these details, and it requires many in-depth conversations with each of your individual situations. So again, this is a very general overview, but again, we are a resource for you to reach back out to so that we can really examine your individual goals and situations to help guide you. All right, Selma, you've got some points with regards to how budget and buyer requirements go hand in hand while you are in the process of the home search, as well as the role and importance of the real estate agent in structuring offers. And you need to unmute yourself, Selma.
Okay, thank you very much, Rob, for having me. Hi, everybody. So anyway, I want to talk about some really, I guess, two critical points when you're buying your first home. Number one is budget, what you can afford. And that's really critical. You want to understand your budget. And second is you want to establish a set of requirements. For instance, do you need a house with 2 bedrooms, 3 bedrooms? What location do you want? Do you need something with a garage? So basically those go hand in hand. Budget and requirements are critical. So once you have that, you're kind of on your way. So I want to actually give you a real life example of somebody I've been working with the past 2 months. They're buyers in San Francisco. They have a newborn. And they came to me about 2 months ago saying, Selma, we want to buy a house. We're really excited. First time home buyers. I said, great. They were pre-approved. Number one, what was their budget? They told me 1.7. I said, great. Okay, now let's go over the requirements. They said, we would like 3 bedrooms, at least 2,000 square feet. Would love a garage and would love a remodeled kitchen and bathroom. And these are the neighborhoods we want in San Francisco. I said, great, fantastic. Let's go take a look. Let me see what's on MLS. So what I do is I first kind of let the buyer give me their budget and their requirements, understand what they're looking for. So I looked at that, and what I realized is based on their neighborhood locations, inventory and homes were very limited for what they're looking for. So we sat down, we went back to them and said, guys, you know what, for 1.7, the inventory is very limited to what you can buy. I said, we can either scale down, maybe instead of 2,000 square feet, we do 1,500 square feet, or maybe different location, because obviously different locations will carry different pricing throughout San Francisco. So we thought about it for a couple of days. They said, you know what, Selma, location is key to us, but we'll scale down on, it doesn't need to be perfect finishes for the kitchen, but maybe a good layout. We can also renovate later on. And let's scale down our square footage. So basically there's trade-offs, and that's what you learn when you're first looking for a house. It's also really fun because I call it the buyer's journey, because I tend to work predominantly with buyers, which I really enjoy. So we kind of lay out what the requirements are based on our budget. And we realize, you know what, maybe we need to scale down, and that's okay. So we want the location we want, but we might want small square footage. So those 2 elements are critical. And then once you have that, you feel confident that, hey, look, when something comes on the market, you understand what you're looking for and your needs. So that's, between agent and buyer, which gives you, success in finding something you want to purchase. So that's key. The next point I want to talk about is when you do find your dream home, which is exciting. The other process really critical is your offer and how you're going to negotiate that offer. So it's because obviously when you put an offer in, I always tell my buyers, do you want to be a winner? Yes, you want to be a winner. You want to be able to get your bid accepted. And that's the name of the game. And that's, and buyers, so everybody wants to win. So how do you win a bid? Okay, number one, I think the most important right now is knowledge and education. So that comes with Sylvia stepped upon us working with a seasoned agent that really understands the market, the analytics. It's not just looking at, printing out data sheets from MLS, but really understanding the data that you're looking at. So what I usually do is when I first we find a house that we like, I'll say, great, let's pick a neighborhood, let's say North Beach. We'll look at that, we'll look at the houses within a quarter to a half-mile radius. And I'll look at different differences, similarities, what's the per square foot amount, and really kind of understand. I'm also educating myself. Plus, I want to educate my buyers. So when we come up with a pricing strategy, everybody kind of understands, hey, you know what, this makes sense. We want to price it based on the competition, or maybe this might be priced a little bit higher because it has a corner lot. So you want to go through all that. And that's, so education and knowledge is important. Second point, when you're making an offer, aside from just knowledge and education, you also want to understand the competition in the marketplace. What is, in other words, with pricing strategy, if you're in a very competitive market with limited inventory, even though you look at all the per square foot amounts, you might also have to understand that prices might get pushed up. Let me give you an example. So I just, last year I worked with a buyer that really wanted to be in a particular location in San Francisco. We were looking within, a 10-block radius. Nothing really came up. And finally something came up, limited inventory on one of the prime streets. So she's like, well, you know what, per square foot, it's penciling out to 1,000 square feet. Let's just use that number hypothetically. I said, correct, it's 1,000 square feet, but this is on a prime street. So there might be, and it might attract a lot of buyers. So guess what? You might have to push up on the pricing. So maybe to win the bid, we might have to pay another 50,000. So that's what I mean about competitive pricing relative to the market. So you have to understand the square footage, which is education knowledge. Then you have to understand the competitive nature of the market that you're in to understand what you have to offer. And lastly, which is also very important, is contract terms. So when I'm writing up purchase contracts with buyers, obviously price, you want the highest and best price, but also what's important are terms. You have three important terms. You have loan, you have appraisal contingency, and you have inspection contingency. By default, all those in the purchase agreement defaults to 17 days. So you can say to yourself, 17 days doesn't seem like that long, but it could be long. In a competitive market, even if it's not in a competitive market, you want to win the bid, right? You want to be a winner. You don't want to be a loser. So you say to yourself, so I'll give you another example. So we were in a market where they were fully underwritten. As Ed touched on, we were fully underwritten. So I said, you know what, we want to be competitive. This is a prime, we're looking at a property which is going to attract a lot of eyeballs. So why don't we maybe, instead of 17 days for loan, if you're fully underwritten, and let's talk to your banker, if you feel confident, why don't we remove the loan contingency? So instead of 17 days, it's 0 days. So guess what? It looks like almost a cash offer, even though you're getting a loan. So that's a great, so you can make that 0 days if you want to, or you can cut it in half. Any kind of shortening of loan contingency is going to improve your chances of winning the bid. Appraisal, I usually leave alone. It's 17 days again, but sometimes if you want to shorten a little bit, you can. Usually 99% of the time I see properties appraising out. That's usually not a problem. And lastly is inspection. So when you buy a home as a first-time buyer, you'll notice they have something called disclosure packet. And in the disclosure packet, you have the California statutory requirements, plus you have termite inspection plus home inspection. So you can read those 2 inspection reports. If you feel confident that based on what you're reading, there's minor dry rot, which is maybe going to cost you $5,000, or the house is clean, there's nothing wrong with it, you can waive those inspections. Or if you don't want to waive them, you can shorten them up a bit. So that's another way to be more competitive. So I guess to sum it up, what's important is the detail. And understanding the detail and how you structure the deal, because that leads to success. And starting from budget, affordability, and how you structure the contract, and working with an agent that really understands the market, the price for strategy, and that'll lead to a winning bid. So I hope this was helpful.
Selma, great information. Thank you
Good.
very much.
Good.
All right, buyer's myth number 1. I can't afford to buy a home right now. Those who are renting often do not fully understand the tax benefits of homeownership when thinking about affordability. Certain deductible expenses, such as a homeowner, decrease tax liability, thus increasing your purchase power. Alexia, can you speak about this further to help our guest examine rent versus own scenarios further?
Of course, I'd be happy to. My first response to that is you can't afford not to buy a home right now. And I truly believe that. If you think about how much you're spending on rent in the Bay Area, say it's $5,000, multiply by that by 12, that could be $60,000 a year, times 10 years, that's $600,000. I think most of us cannot afford to throw that money away. And people will say, yes, but when you buy a home, you're still paying about the same amount or more, and you're putting it into mortgage interest. But the difference there is the mortgage interest is deductible. So it's a win-win. So you're building equity and you're getting deductions on your returns. But do run the numbers, consult with your tax professional, and make sure that it actually does work for you. And I urge you to run the numbers both ways. Run walk returns as a renter and into your dream home and see the difference. And because if you're renting, most likely you're taking the standard deduction, which was $12,950 in 2022. It's $13,850 in 2023. Versus if you're buying a home, you're going to be deducting your itemized deductions on your returns, which you can deduct up to $10,000 on your property taxes each year, as well as all of the qualifying mortgage interest paid on up to $750,000 of interest on that loan to buy or build your primary residence. And that does include if you're taking an equity line out to do some construction on the home, that's okay. What it does not include is if you're pulling cash out on a refi, that does not include, that does not count. And then again, as well, when you sell that home that's hopefully has appreciated, especially in the Bay Area, you can exclude up to $250,000 of the gain on the sale of your primary residence each person. So if you're married, that's $500,000, and you have to have lived in it in 2 out of the last 5 years. But the big question I get asked is, how do I increase my income to get into the house of my dreams? If you're getting a W-2, there's not much you can do to increase your income. So work on your credit. As Ed was saying, there's multiple factors that impact. But if you've got a Schedule C and you're sole proprietor, something that people don't realize is you are required to report all of your income, but you are not required to report all of your expenses. So if you're thinking about getting into a home, definitely check in with Ed or your mortgage broker to determine, what you can afford. But remember, you don't have to report those expenses. So that's a great way to increase your income, your taxable income, so to speak, to qualify. Now, can you amend those returns later after you buy your home? Believe it or not, people ask me that. No, that's tax fraud. You're going to have to pay that tax on that higher income, but it may be worth it to do that for a couple of years and get into the home that you want. And get on track with your life goals and dreams. And the other thing that people always ask me is, how much income do I need to get into the home that I want? Well, that's where we would call Ed, and work backwards from the home that you want to see what you need. Get that in advance, get pre-approved. And then once we know what home you're going to be in, if we know your tax is going down, we can adjust your W-4 and reduce your tax withholding if needed. So you are going to get more money out of those paychecks, whether they're on a 24 or 26 week cycle. And people always ask me, how many years ahead do I need to prepare? They usually look at 2 years returns, but if you're thinking about it in the future, go and get pre-approved now and start working on those numbers so that you can make sure, work with your team ahead of time, and you know exactly what you're getting into, and then it's not as scary, and you can really see how those numbers affect you to get into your home, because you really can't afford not to, especially with the rents as high as they are.
Alexia, thank you very much. A lot of great information. Thank you. I'd also like to remind guests at this time that there's a Q&A link at the bottom of your Zoom screen. So if you want to present any questions for us to address toward the end of the meeting, this might be a good time to think about those questions. First time buyer myth number 2. I am going to wait for the market to get better. Eli, you were going to share some thoughts on this. And you need to unmute yourself.
Hi, I'm Eli Meyskens with Novo Real Estate, and mine's going to be the shortest answer yet, just dovetailing on Ed. Don't wait. Don't wait. No one can predict the market. It's the shoulda, coulda, woulda thing. Everybody wishes they had bought 5 or 10 years ago because the house would be worth more. Just don't wait. Usually by the time the market recovers, it's too late and prices have gone up, or competition has already picked up, as Ed said, or both. So a wise broker once told me the best time to get into the market is when you can get into the market. So talk to Ed, talk to a mortgage professional, talk to your bank. If you can afford to do it, and don't wait. For example, times like right now, in real estate, when it's slower or a down market, it creates opportunities on the other side of the interest rates going up, like Ed was talking about, because there's price reductions, houses sitting on the market, owners panicking because they're doing the shoulda, coulda, woulda because they wish they would have sold last year. And so this is the time, like Ed said, to get in, ask for reductions, ask for, terms, ask for, and by terms, there's lots of different things you can do during a down market. Like Ed was talking about, interest rate buy downs, seller carry, where the seller helps you with the loan. That's a whole nother meeting in itself, as Ed said. But in this kind of market, there are all sorts of things that you can do to benefit from not benefiting from the lower interest rates. And an example I have is I was working with clients that had got themselves all prepared during the boom time, but they were in a price range that was just too difficult to compete in. And they kept getting offer after offer after offer after offer turned down, but didn't get discouraged and stayed in. And at a time when everybody was getting out last spring, when the market started to tank and things started to turn, everybody got scared, and they went from, putting in an offer and 50 offers coming in to being the only offer, or 1 or 2 offers, and they got a house almost immediately. So that's just another reason to not wait. Don't wait for, no one can predict the market. Again, it's if anybody could, they'd be a wizard. But there's less inventory during these times, but there's also less buyers out there, which is the most important point. As again, like Ed said, you're not competing with 50 people, you're competing with less people, and you're able to do more negotiations. Waiting to buy also means the prices usually are going to go up, because if you wanted to buy 5 years ago and you didn't, that house is worth a lot more than it was 5 years ago. And everybody is kicking themselves for not buying when they could have. And it's all about, like I said earlier, finding out if you can buy, and if you can buy and the numbers work out, you have the down payment, you have the financial stability to do it, then do it. That's why it's important to get in, and think of it as an asset, as an investment. As Alexis was saying, it's, this is something that is part of your the building blocks of your life, of your financial stability, your financial future. And, there's really kind of nothing more important financially than having that kind of bedrock that is a home. And all this time that you spend waiting for the right time is time that your house asset investment could have appreciated. So short and sweet, don't wait. Talk to Ed, talk to your bank, talk to your spouse, talk to whoever you need to, and find out. And as soon as you're able to get in, and then you're in. Then, then you can keep that house, roof over your head, don't have to pay rent anymore, and all the tax advantages that we talked about. And then, over time, that asset will grow. So good luck.
Thank you, Eli. So once the buyer is in contract and we've already got a pre-loan approval, the bank will order an appraisal of the subject property. Keep in mind, a bank appraisal isn't so much about confirming market value. It's more of a confirmation for the bank that the subject property is sufficient collateral to secure the loan for the set purchase price. Once the bank has approved or provided the final loan approval and all other contingencies of the contract have been met, the parties are prepared to close escrow. And that moves us into the introduction to Gary with the title and escrow company. And Gary, perhaps you can kind of give us the overview of the role and relationship of title and escrow.
Thank you, Rob. Yes, after you've gone through all this process, now we're ready to close the deal. As a title and escrow company, we will act as a neutral third party in between the buyer and seller. So it's a buyer pay in San Francisco, so you're paying for the title insurance. So once we get the escrow open, we put you with one of the professional escrow officers, and they will send you an email with a link. And with all the fraud and running around these days, you want to make sure that you're talking to the right person, and that when you're wiring your funds, it goes to the right place. So we have a secure in-here portal that the escrow officer will send you instructions to the buyers. That's why we ask for the buyer's cell number and email address. And once you get communication with your escrow officer, they'll send you the information on wiring instructions and where funds are to be sent. These will never change. So we have to remind people, sometimes they'll get a spoofed email for saying, hey, we're the escrow officer and your lender and I, we need to get new wiring instructions to you. Always go back to that first email from the escrow officer and call them. Never just wire funds because you got another email, because the emails can look very, very similar to what they are, but they're missing a character. So that's what we're really trying to do, due diligence, and not have your funds go to a fraudster. Then the escrow officer will coordinate your funds. We do a title search on the property, making sure that we take care of all the title issues. You'll be issued a preliminary title report, and that says that who owns the property, what all the liens are on the property, and your funds. We will take those funds to take care of those liens and pay the sellers mortgages off. And so when you get the property at the end of the transaction, you actually own the property that you bought. And you and the bank will own the property. The title insurance protects you from the minute you take ownership going backwards. So if Uncle Joe comes out of the woodwork, 5 years later and says, hey, that was my property, I didn't authorize to sell it. The title department, because we've done due diligence and done searching, we will go through the process and try to validate that. And if for some reason it was true, then we'd have a claim. But most often, it's just someone trying to get to scam you. So a lot of people will say, well, do I have to have title insurance? And that's one of the scenarios I like to use, because if Uncle Joe does come out of the woodwork and saying, hey, I have a deed to this property that these people bought, or that you bought, and you don't have title insurance, then it's up to you to hire your own attorney to disprove that. So because you have title insurance, we will do the research for you to verify that. And then I think that's about it. The important thing is when you're in the transaction is you've trusted your agents through the whole process. And then when you get the escrow officer, that's who you want to correspond with to make sure that you don't get any false emails or things like that. They're going to be the ones that walk you through, handhold you, and get you to close your deal. They'll set up the signing for the closing. Right now with COVID, we do the mobile notaries. So if you get to your signing, you have to have proof of ID, picture ID, and then meet with the notary and sign the documentation.
And part of the process, Gary, is your office is going to handle the recording of the deeds.
That's right.
And after that, congratulations, you've become a homeowner.
That's correct. Yeah, we'll once everything's signed, we will get it recorded and copies will be sent to all the parties.
Super. Thank you, Gary. So a lot of information. Gina, can you kind of recap on some of the benefits we've talked about in terms of buying now?
Thank you. Indeed, that's a lot of information. So let's see, to recap, owning a property will be putting you in a long-term investment growth while building equity and paying down debt and enjoy the benefit of property appreciation. Remember, just like what Alexia said, rents do not build equity. So as an owner, another point is that as an owner, you get the pride of ownership, feeling of stability, security, knowing that you are the owner and you are not at a risk of any rent increase or owner eviction. Just like what Eli mentioned, it's a roof over your head. And then you develop a sense of community. Why? Because you'll be more aware of your community and you would want to be a part of and having a vested interest in making sure that you will have a better future of the community, because when the time comes and you're ready to sell, you want to be able to get the highest and best price as well. And community or the environment of where your property is located scores pretty high on that category. So another thing is the freedom to customize your home to your own specific standards and lifestyle, and the best benefits, the tax benefits that you get, the benefit of writing off the mortgage interest. And again, to reiterate, rents do not have any tax benefits. So when it's a good time to buy, like everyone mentioned, if you can afford it now, hey, I say it is the time, especially now, right? And hopefully that helps everyone. And in AMSI and Novo and everyone's behalf, we thank you for joining us. And hopefully this has been a helpful one for you. See you again.
Rob, you're muted there.
Sorry about that. I keep forgetting about that. So we've got a number of guests, and Gina, thank you, by the way. We've got a number of guests, but no one has posted any questions. So I guess we've been pretty thorough, taking a look again. But by all means, this group is going to be available to you as a resource in a minute. Jackson is going to actually display everyone's contact information. We will actually be happy to share this recorded meeting if you want to review it in the future. I'd like to take a minute and thank Jackson for actually coordinating this wonderful webinar and handling all the technical aspects of it. Thank you for that. And I also want to just say thank you to the panel here. It's really a pleasure to have hosted this with you today. And it's a pleasure to partner with you in the industry. This has really been a great seminar. And since we've got a couple minutes, if there's any closing thoughts from anyone else, feel free to speak up before we adjourn the meeting.
So I see one question here, and it's for Ed Diaz. It says, date the rate, marry the property. Ed, is that something that means anything to you?
Means a lot, and it should mean even more to those who are watching. And if you're a buyer, essentially what this means is this: we're going to teach you how to bake your cake and eat it too. Here's what it means. You buy the property now, and like Alexia said, while the cake is baking in the oven, you're going to get the tax write-offs for the mortgage interest and the property taxes. And then you're just going to leave it in there a little bit longer. But while you're doing that, you're getting the tax write-offs and you're getting and building equity versus your landlord, right? And then we take it out, we refinance it, right, and get you the best rate. I said in my forecast, we're going to go to the 5s and maybe even 4s by next year. So you'll be able to bake your cake and eat it too, meaning you're going to marry the property right now, date the rate because you're not going to keep it, and then we'll get you to marry the date later on, or the rate.
Love that. All right, anyone else? Any other closing comments?
Thank you all.
Jackson, Ed, Alexia, Gary, Sylvia, Selma, Eli, and Gina, thank you. It's been a pleasure hosting this webinar with you today. Thank you very much.
Thank you all.
All right, take care.
Take care.